Well, welcome everyone to today's webinar, Small Loans and Large Growth. Whether you're here as a prospective borrower or as an investor, you'll learn how to start and grow your multifamily investment portfolio and maximize your returns. I'm your host, Sam Chandon, founder and chief economist of Chandon Economics, and in my academic life, dean of the Schack Institute of Real Estate at New York University. Today we're going to discuss several facets of the small balance space. First, I'm going to spend just a couple of moments talking to you about small balance itself. What do we mean by small balance loans? How large is the market, and what are some of the opportunities? Then we'll have a discussion with our guests with regard to some of the trends in the space and some of the opportunities to actually be an investor or borrower. We'll have a Q&A with our panel of experts, how small balance space changed over time from both borrower and lender's perspective. How are the needs of a small balance loan borrower different than a borrower for a large loan? How has the technology that we used in the lending space changed to better meet borrowers' needs over time? And what's the future of the small balance market and how it will react as the economic outlook and economic conditions change? From there, we'll have a Q&A with you, the audience. And if you have questions that we're not able to get to during today's webinar, we'll provide you with the opportunity to get in touch with us so that we can get back to you one-on-one. Before we get started, let me introduce you to our panel. First, Ivan Kaufman. Ivan has been spearheading the development of innovative real estate companies for more than 3 decades. He's currently the president and CEO of Arbor Realty Trust, a publicly traded commercial real estate finance investment company. He's also the founder, chairman, and CEO of Arbor Commercial Mortgage, LLC, a leading multifamily real estate lender. Latest venture, Arbor Loan Express, was created to make the multifamily financing experience more efficient and client-focused for small balance borrowers in particular, and we'll talk a little bit more about that later today. We also have Freddie Mac's own Stephen Johnson. Steve leads Freddie Mac's multifamily small balance loan business unit and manages all aspects of Freddie Mac's small loan program, which funded more than $2.5 billion in small multifamily loans last year alone, and since its inception, has done more than $3.6 billion in loans. Under his leadership, Freddie Mac is delivering innovative financing solutions that are uniquely suited for today's multifamily property owners and investors, making finance fast and simple. Gentlemen, thank you both for joining me here today.
Thanks for having me.
Just 2 points I want to mention to the audience before we really dig in on the material. As an attendee, you have the chance to ask these 2 experts any questions that you may have about multifamily finance and investment. On the right-hand side of your screen, there should be a section labeled Ask a Question. Feel free to enter your questions there as we move through the webinar. We'll answer them towards the end of today's program, and again, if we miss something in that discussion, we'll make sure to follow up with you after the webinar concludes. If you missed something that someone said or while you were jotting down your notes, don't worry about that either. We'll be sending you a recording after the webinar concludes. So the first question that a lot of folks may have that are new to the small balance space is, what do we mean by small balance? And there's no fixed and formal definition that everyone in the industry is going to agree to, but there are a couple of generalities. In particular, when we're talking about small balance lending, we're generally referring to loans of between $1 and $5 million and multifamily properties of between 5 and 50 units. And in particular, when you look at some of the research that we're producing in this space, we're going to use that as our common definition for small balance market and small balance lending activity. In terms of how large this market is, the interesting thing for a lot of investors in the market who particularly are new to small balance is that it represents such a significant share of overall activity. By our estimation and our modeling, small balance loans in multifamily actually represent about 65% of all of the multifamily loans being made. By virtue of their smaller size, lower visibility, they're about 20% of the total volume. But again, to give you an idea of the trajectory of this market over the course of the recovery and return to expansion in the macroeconomy, since 2009, volume in the small balance space has tripled from an estimated $11.1 billion in 2009 to, in 2015, $44.3 billion. Our estimate for the first quarter of 2016 is $12 billion, which puts us on track thus far into the year to have the biggest year in multifamily lending that we have in our records. The total commercial multifamily mortgage origination volume is 26% higher in 2015 than it was in 2014. The market moved up from about $400 billion to about $504 billion. and that 2015 figure is second only to the total borrowing volume in the United States in 2007. Multifamily was $201.7 billion of that 2015 total, and comprised the largest share of any of the different property types for which we lend in the commercial real estate space. We've got strong price appreciation as well as higher volumes, and that's no surprise because empirically those two things tend to move together. As of December 2015, prices in the market were about 38% higher than they were in the pre-recession period. Surging demand and a lack of supply in many segments of our market have been responsible for pushing some of that annual price appreciation to a range of about 13 to 15%. Now, I think that's also interesting for folks who may be in the core multifamily business, because we do tend to hear a lot about some of the new supply that's coming online for core multifamily. When we break down and disaggregate some of those multifamily construction numbers, some of the things that we're going to see is that we don't have robust construction, development, deliveries for other property types, but in multifamily as well. A lot of the activity is concentrated in the urban core, in mid and high-rise buildings that are well amenitized and appealing to a very specific demographic. When we look at multifamily more broadly, and in particular when we look outside of the core urban area or to relatively smaller urban properties, multifamily properties, I think what we begin to see there is that the supply picture looks quite different. And it may not be the case that we have an overwhelming number of multifamily properties coming online. In fact, what we see is that in many segments of the market, we're supply constrained in a way that is driving up rents for multifamily renters. Now, with those higher prices and higher rents, cap rates have been falling. And as you can see on this chart, when we look at small balance transactions and isolate them out from the multifamily business as a whole, what you'll see is that the difference in the period immediately after the financial crisis, the gap between the cap rates for small balance loans versus all transactions, it was fairly wide. But over time, as we've seen liquidity return to the small balance space, as we've seen a greater diversity of lenders, as Freddie Mac has become more active in the space as well, providing for additional liquidity in this market, the cap rates, debt yields, other measures of market activity have narrowed. And so the gap that we have now between the small balance space and all transactions in the market is the narrowest it has been since the beginnings of the financial crisis. And again, that reflects a number of different features of the market, but also I think as liquidity has improved, as we have better access to debt, as data and information about the performance of the small balance market, we've got greater transparency there, that changes the risk profile of the small balance space in a way that is reflected in part in the cap rates that we've got in the marketplace.